Hello, passive investors. Welcome to Passive Pockets, presented by Equity Trust. I'm your host, Jim Pfeiffer. As we know, a critical part of investing is knowing who you're investing with. So today, we're going to meet Brian Spear from Sunrise Capital. Let's get into it. So, Brian, thank you for your support of the Passive Pockets community, and thanks for being on here today with me.
No, my pleasure, Jim. Looking forward to adding more value, as much as we could possibly add, buddy.
And we appreciate that. So to start, just tell us about Sunrise Capital, what you guys do, what do you focus on?
A little bit about Sunrise. Been operating for a little over a decade now. What do? We're in two specific niches. We like to consider ourselves deal aggregators in niche real estate sectors. We cut our teeth in mobile home parks. Been doing that for over a decade now. And then the second niche that we have is parking. So parking lots and garages. I've been doing that for about 5 years. Consider ourselves kind of light value add operators. Happy to dig as deep as you'd like there, Jim. That's a high-level overview.
Yeah, I appreciate that. I do just want to ask one clarifying question because I know you were at the summit, the Passive Pocket Summit, and a question I didn't get to ask you then, but I've asked you before because parking lots is a little bit new. Most people understand a little bit about mobile home parks, but parking lots, that's a different asset class. Can you just briefly talk to us about why that's an attractive asset class and that driverless cars aren't going to make it obsolete?
Well, to the former. We love it because real estate's all about location, location, location. And from my perspective, you'd be hard-pressed to find a better location than a parking lot, right? Where somebody's literally willing to pay you just for the right to stand on the piece of land that you own. So you're likely in a very high-value downtown urban CBD or extremely high-traffic tourist destination. And again, some of the facilities that we've acquired have been in high demand for literally hundreds of years. I mean, we're about to unveil a parking facility in downtown Philadelphia that literally is walking distance from the Liberty Bell and walking distance from Independence Hall, where the Declaration of Independence was signed, okay? It's been in high demand literally since the founding of the country, and I would imagine it's going to be in high demand for the foreseeable future. I can't tell you maybe what that underlying land use is going to be in 100 years or 200 years or 500 years, but I can tell you that the underlying location, very likely going to be in a high demand at that point. So that's one piece of the puzzle, and I'm happy to go as deep as you'd like there. It also bodes very well for kind of our core competency, what we've historically been very good at, operating in niche real estate sectors. You know, my business partner's been doing it for literally decades, going off-market, direct-to-owner to acquire deals in non-competitive environments. We felt like we were ahead of the game in mobile home parks when we started buying them 15 years ago, and feel like we're ahead of the game in parking right now. You know, nobody was bragging about owning mobile home parks around the water cooler 15 years ago because they were all trailer parks, et cetera, et cetera. And now today, I really don't know many people doing what we're doing in parking. I literally cannot think of one human being doing what we're doing inside of parking right now. So we feel like we're ahead of the game in this regard and can buy some deals that have some relatively fat margins before the industry gets consolidated. I'm happy to elaborate. But to the latter point, I would say the following. By no means do I have a crystal ball, right, in terms of understanding what new technology is going to unveil decades down the road. But you know, prior to diving into this niche, we did an exorbitant amount of research to try to ensure that running a SWOT analysis, we weren't going to be shooting ourselves in the foot along the way. And all of the industry experts in the data, you know, crunching all the numbers, would suggest that for multiple consecutive decades from today, the demand for vehicles and parking will continue to be on the increase, on the upswing, dependent upon what happens with autonomous vehicles. And when we take the literal worst case scenario, i.e. the high adoption of autonomous vehicles, where everybody immediately jumps in and starts driving autonomous vehicles at their disposal, it means that from all the data that we could possibly acquire, that the demand won't plateau literally for decades. And that means that over the next several decades, from our perspective, more than enough runway to buy up some really high quality assets in exceptional locations, allow the long-term macroeconomics to do their thing where the value increases for multiple decades before any of those potential changes come down the road. And we'd be able to keep our finger on the pulse the entire way and have a little bit of a visibility in advance of how the adoption's going during that multiple decade duration. The last thing I'd say on it is the following. Nobody's going to know more about autonomous vehicles than guys like Uber, right? The guys that are out in front of it, trying to understand how to beat the system with that. And the founder of Uber is a gentleman by the name of Travis, I'm going to butcher his last name, Travis Kalanick. In any event, after he left Uber, he ended up rolling out a brand new venture. And his venture was to ultimately, he raised over 9 figures in an effort to go try to buy parking. Why would he go do that? Because he sees the writing on the wall and understands that if his vision of autonomous vehicle ultimately comes to fruition, yes, the parking may change, but ultimately he's trying to get out in front of buying all those assets in advance so that the underlying use actually increases. Parking is often the least valuable underlying zoning in an MSA. And if ultimately something occurs that changes the demand for parking, I would rather own those properties and turn them into something else, bigger, better, different, with a higher value to the local municipality than what a parking lot or facility would be. So that was literally what he did immediately upon leaving Uber. So in any event, from my perspective, by no means do we have a crystal ball and et cetera, but we feel very confident for the next several decades that we're going to be in a very good position with those parking facilities.
Well, thank you for that. I didn't mean to make this into a parking webinar, but you gave a great succinct evaluation of it. So I appreciate that. Now we're gonna jump into you and real estate. So how did you first get into real estate just generally?
Well, in short, I always knew that I was going to get involved in investing. And now, we've been in mobile home parks for over a decade now. We've owned assets in 18 different states, all over the country, done 17, 18 full-cycle mobile home park deals. But my first experience with mobile home parks was when I lived in one when I was 10 years old. My parents got divorced. My dad moved to Gary, Indiana. My mom moved to a single wide in the south side of Chicago. And from that point, I just knew that I was going to work extremely hard to try to put my family in a little bit better financial position when I was a little bit older. So suffice it to say that I went through a long rabbit hole of working extremely hard academically and athletically to put myself in a position where we could make that happen. Expediting the story, got a lot of different scholarship offers all over the country, taught myself how to switch hit both right-handed and left-handed so that I could get scholarship money because I couldn't pay for college, right? So I taught myself how to switch hit. Ended up landing at the University of Kentucky where I became captain of the baseball team, not because I was the most talented guy, just worked super hard, and graduated one step beneath academic All-American. So right after school, had the chance to either go play professionally in free agency or alternatively go take a real job, and chose the latter because I had 6 different job offers and chose the job that was going to make me the most money. Not because I was the greediest guy in the world, but I knew that what I wanted to do in the short first few years of my professional career was to build a pile of cash so that I could turn it into streams of income through real estate. And did just that. Took a job where I ended up branching off and was the 6th employee at a company that ended up scaling really significantly and ended up going full cycle and sold for an undisclosed multiple 8-figure exit. And was able to understand how to scale companies during that experience and ultimately reached out to Kevin, my business partner, and with an offer that he couldn't refuse. I'd known him through the podcast universe. He started his old podcast in 2012, 2013, reached out to him after hearing 5-10 episodes, understanding that he'd already bought 1 or 2 mobile home parks. It was going to be a great match from my perspective. He had a great business model. He's been in real estate his entire adult life. I like to say he's never had a real job. Started buying real estate when he was 18 years old in single family, tried a lot of different things, but ultimately found mobile home parks. And I knew that I could scale that significantly because at the time he was using his own capital to go buy more modest sized mobile home parks. And I reached out to him and said, hey, bud, I'm going to move down to Florida. I'm going to, work 60, 70, 80 hours a week. I'm going to invest hundreds of thousands of dollars in your business. I'm going to try to help you grow your business. And I think over time, we'll be able to grow it into something pretty significant and sweet and help a lot of people along the way. And that was kind of what prompted growing Sunrise from just really, truly an individual buying mobile home parks personally into a company where we were looking to do deals together with our own capital, and then we kept on growing. We started doing some friends and family deals, and then eventually bringing on some additional partners along the way, and that's now grown to where we started doing fund structures in 2017 and leads us up here today where we've raised multiple hundreds of millions of dollars and brought on hundreds of partners along the way, et cetera. So again, it's been an amazing run and can't wait to just see where it leads us as we progress.
Yeah, that's awesome. Great backstory. So, you've done, like you said, you've been in this business for a decade or more, and you guys have done a ton of deals, and I am guessing that maybe it hasn't been all smooth sailing just up and to the right. So, at least in my experience, the best way to learn is the second best way to learn is from my mistakes. the best ways from someone else's mistakes. So assuming that you guys have made a mistake or two, can you tell us a lesson that maybe you guys have learned that could kind of help us just understand, okay, everyone, things go bad sometimes, but how do you get out of it, and what's the lesson learned?
Yeah, right. As the old adage goes, right? If I have seen further than others, it is only because I've stood on the shoulders of giants. Of course, I'm going to try to learn from others' experience as well. So, yeah, of course, it's not all sunshine and rainbows. Not every deal is perfect. One of the deals, I'll give you an example. We got multiple, but one example that I'll share is the following. We bought a deal in Oklahoma, mobile home park. We ended up buying it for like $3.3 million. And in our universe, it is extremely rare to see mobile homes leave, to see mobile homes move out of a mobile home park. Typically, mobile homes only move twice. They move from the manufacturer to the mobile home park, and then they move from the mobile home park to the dump after the end of its useful life expectancy, literally decades and decades and decades down the road. And the reason is because it's prohibitive. It's cost prohibitive to move a mobile home. When you move a single wide, it costs $7,000, something like that, $7,500. You move a double wide, it's $10,000, a little more. So let's say a resident owns their home, and the lot rent is $350, and down the road the lot rent's $370. Well, to save $20 per month, they'd have to pay $7,500 to move the home. The break-even cost just doesn't really make sense, right? However, this deal was unique. We actually had some homes leave, and we were trying to get out in front of what happened here. So ultimately, we second home leaves, and we catch wind of the fact that one of the local operators in the vicinity, an old school mom and pop guy that developed a mobile home park many, many, many decades ago, was retiring, riding off into the sunset. And unlike most people who ultimately just sell through a broker or sell it to another operator, ultimately he decided to sell each of the individual mobile home lots to the residents inside of his community. And while the good chunk of them were occupied with homes, there were some vacant mobile home lots. And he was selling them so unbelievably dirt cheap, to the point where they were like $5,000, $6,000, $7,000, something like that. And if you take into account the cost to move the home, plus the cost of the land, call it all in $10,000, something like that, for the residents to move the home, buy the land, a little bit more than that. You start running the numbers. If you're charging $350 a month in lot rent or $400 a month in lot rent, the break-even period starts to become more realistic from the resident's perspective. If they know that they're going to stay in that mobile home for the next few years, they start thinking, okay, well, it's actually better financially in my best interest to just plop down the $10,000 today, and then at some point in the next few years, I will have no housing costs. So we ended up seeing a lot of that occur, and ultimately we ended up, I think over the course of about a 9-month stint, we had something like 15 homes leave the community, which was, egads, more than what we'd ever seen. It just never really happens. And so, we bring in 5 homes and 5 homes leave. It's kind of like we were on a canoe and we're just like shoveling all the water out of the canoe. We're just trying to stop until all the vacant lots were sold down the block. We just had to really pedal as hard as we could, trying to keep the property afloat and keep the net revenue occupancy as high as we possibly could. The RPS, revenue producing sites, as high as we possibly could. In any event, the end of the story, end of the rainbow, is that we bought the property for $3.3. We ended up selling it a few years later for like $3.6 million. It wasn't the style of outcome that we would have otherwise anticipated with that property, right? If you look at the original deal, underwriting, what we had hoped to achieve with that individual asset, we didn't kind of meet the mark, as it were. But this is why you buy deals with a nice margin of safety immediately at acquisition, buy deals with cash flow. You have to ensure that you're protecting the downside risk across the board. And those are the sorts of things that keep you out of a really precarious situation. If you have the appropriate longer-term debt on deals, et cetera, all the things that we talk about in a more granular manner in other areas, we're happy to dig deeper as you'd like. But those sorts of things that you institute on the front end preclude you from putting yourself in a scenario where literally the result is literally losing all of the equity in the capital stack, right? Losing all the investors' money. So not the outcome that we would have otherwise wanted, but better than a worst case scenario, as it were. So you live and you learn over time.
Yeah, absolutely. So I want to pivot a little bit to financial freedom. That's something a lot of people in our community are looking to become financially free, whatever that means to you, and it means different things to different people. What does it mean to you to be financially free?
Well, for us, there's so much there, right?
Yeah.
This is why we all do what we do. Every single individual has hopes, wishes, dreams, things that they want to achieve for them and their family. And I would put it in terms of the great Dan Sullivan and how he explains this in Strategic Coach. Multiple different types of freedom: freedom of money, freedom of relationship, freedom of time, freedom of purpose, and freedom of health is something that we would add to that as well. Just trying to reach a level of self-actualization, living your best life that you possibly can. And we all have hopes, wishes, dreams, things that we want to be able to accomplish. For me, it is just that. It is reaching a level of self-actualization so that we can have freedom of time to be able to do what we want with our family, right? Living life on our own terms. That's what it is for me. And that's really what we do at Sunrise. From my perspective, that's literally what we're trying to achieve for everyone in the stakeholder chain. Our slogan is that we're a proud supporter of the American dream. And the reason that we landed on that is because everyone in the stakeholder chain has hopes, wishes, dreams, things that they're trying to achieve. Whether you are a resident inside of one of our communities, right? We provide the last bastion of unsubsidized affordable housing in this country. It's oftentimes the only opportunity for somebody to live the American dream of home ownership. Those folks have hopes and wishes and dreams that they want to achieve. We, all the members of Sunrise, the team members, have hopes and wishes and dreams that they want to achieve, right? So we rolled out a Dream Manager program to try to help them not only professionally, but personally in their lives. What do you want to do? And likewise, all of our stakeholders, the investors, the partners that we have, they have different hopes and wishes and dreams that they want to achieve for themselves and their family. And we're just a proud supporter of the American dream, trying to help facilitate that. This is one of the best business models because you can have the luxury of doing well financially while doing good socially, actually making an impact, making a difference, making a dent in the affordable housing crisis. And for me, it's trying to have more time with your family. That's it in a nutshell. At the end of the day, nobody at the end of the day, when they're on their deathbed, said, "I wish I would have made a little bit more money. I wish I would have had another zero on the income statement. I wish I had another zero on the balance sheet." They all say, "I wish I would have spent more time with my family along the way." And from our perspective, that's truly what financial freedom is. It's the drill to get to the hole in the wall, which is spending more time with your family. As they often say, right, nobody buys a quarter-inch drill. They buy the quarter-inch hole in the wall. That's really what I want. You want financial freedom so that you could go spend time with your family. That's what really matters, right? So from my perspective, that's why we're all doing what we're doing.
Awesome. Well said. Last question. What is the most important thing you think that passive investors in syndications should learn or should do to maximize their success in this type of investing?
There's a lot here, of course, right? But I will point to the old adage that you don't bet on the horse, you bet on the jockey. You don't invest in the deal, you invest in the sponsor. And that means a couple of few things, right? I mean, all the guys that are in passive pockets, they've heard that. That's a more sophisticated guys that have been doing this a while. They understand that. They feel that. They see it. They hear it. But I'll provide some illumination onto why that is the case, okay? The reason that I think that this next level is important is because it's about the sponsor. It's not about the deal. And it's why I think that the funds are oftentimes a superior LP investment opportunity than deal-specific structures. Take it with a grain of salt. I'm obviously biased. But when you look at all the different, ebbs and flows, good and bad and ugly, benefits and drawbacks, from my perspective, there's things that oftentimes limited partners don't see that the general partner understands that they may not be privy to or have been exposed to. As an example, if I'm going to give you a hypothetical of a GP running fund structures, one real thing that's going on right now, right? We're doing some pocket listing deals, trying to find additional assets. We literally this past week got asked by a seller of a deal, legitimate sized institutional style asset, to provide proof of funds to close the transaction. And as you can imagine, when you say we've got, $20 million of capital available to close this transaction, you have a lot more credibility than, hey, well, don't worry about it. I don't have all the money in the bank right now. But as you can imagine, like if we can get this deal, I'm going to go send an email to this guy and we're going to go put out we're going to go raise all this money in the next 60 days to go buy the deal. Just trust me. So it's much, much, much more difficult to actually get real legitimate deals that are high quality, wonderful businesses, institutional style assets, as it were, if you're trying to cobble together capital in a short-term manner, right? A fund structure is much more how a professional operator operates, and it leans you to so much more credibility when you're getting deals on the front end, first and foremost. And I would say this is oftentimes overlooked from a limited partner's perspective, that the general partners promote is cross-collateralized against all of the assets inside of the fund. What do I mean? Let's run 2 scenarios, hypotheticals, right? Let's say we had 10 different deals. We were going to do 10 different deal-specific syndications. Well, some of those deals are going to be singles, doubles, triples. Some of them might be grand slams, and then one of them might be a total dud. If we ran deal-specific syndications, 9 out of 10 might go well. But let's say that 10th deal, it's brutal. It's, guys either lose all the money, et cetera, et cetera. Let's just say the GPs get, or the LP gets totally wiped out. What happens to the GP in this example? Well, the GP still feels actually pretty decent. He had 9 different deals where he was doing okay, made up a whole bunch of money for himself and his family. And the one different deal, what happens? Well, the LPs get wiped out, but the GP's still reasonably well off. On the inverse, in a fund structure, if you've got 10 different deals, the GP has to perform across the board. Now, what the LP gives up is the grand slam home runs, of course. They miss out on the grand slam home runs. But it oftentimes precludes the loss of the entire capital of the investment, because your results are likely to revert closer to the mean over time. And the general partner, he might work 3, 4, 5, 6 years. And if that one deal really, he runs it into the ground, he might have worked for 5, 6, 7 years and really not made any money from the general partner promote on this side, right? So from my perspective, adds a significantly better alignment of interest across the board, and also allows you to get better deals along the way. So, that's something that I feel like is an insight that oftentimes is lost on limited partners who haven't spent a lot of time thinking critically about the merits of funds versus deal-specific stuff,
Yeah, well, thank you. That was a great answer. And that wraps up this interview with Brian Spear from Sunrise Capital. Be sure to check out our YouTube channel and subscribe to our podcast for more great insights in the world of syndications. Thanks for tuning in, and as always, happy investing.